Good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and we begin the week with good action in the currencies seen in the previous week. The Indian inflation data was released Friday with the headline inflation at 4.7%, quite closer to the central bank's, mid band or the band inflation band of 2 to 6%. Even the FX reserves saw a good rise after the consistent central bank actions seen in the markets at lower levels. So while the debt ceiling drama and banking sector have taken most of the narrative space for the financial markets, inflation has been moderating in many nations. So, JK, what are your thoughts on the Indian market's performance as well as observing, as we are also observing, flows have started to come by while there is also good discussions around the debt ceiling narratives?
Yes, I think if you look at the recent moves, Indian markets have been far steadier and perhaps somewhat relatively positive. Although, despite steady flows seen, rupee was unable to shake off the effect of RBI intervention, and we are seeing new marginal highs every day on the pair. Apart from the rally in the dollar index, fresh weakness in Chinese yuan and few Asian currencies is also triggering, some sort of buying in the USD INR. Although we again have huge resistance at 80 to 25 and possibly a breakup that takes us to 80 to 50, but that still is not comparable to the big moves we have seen in other currencies. And yes, FI flows have been good. That actually is somewhat surprising that till recently most investors were calling Indian markets commanding too high a premium. So that seems to have been put behind, and they are seem looking to be adding to Indian exposure. And of course, the bond market is also attracting flows because RBI has gone on a pause, and with inflation coming below 5% now, the flows into the bonds should be higher. Yeah. So speaking of inflation, I think even the core inflation came down, to 5.3%, 5.2% last month, and that's a good news from RBI's perspective. So we should look forward to the rate being on a pause for a few months more, while it's too early to talk about rate cuts in India, even as there is a lot of uncertainty about when Fed will do it. Immediate outlook, we look forward to the trade balance data to be scheduled to be released today. 19.5 billion expected versus 19.7 billion in the last month. But if you look at the overall global scenario, there have been far too many uncertain factors to consider by the investors, due to which I'm not seeing any settled trend in the markets. It's no more evident than the big two-way volatility that we are seeing in the bond yields, one day down, one other day up. And the risk surrounding debt ceiling is obviously engaging increasing attention even at the global level. While we do believe that there will be a settlement before the next date, even a low probability risk cannot be ignored by various stakeholders. So at a meeting of G7 in Japan, World Bank President also said, referred to the looming risk of a default, and that would be the first in USSD if it does happen. And it was going to add to problems facing the global economy. On the private investor side, the TradeWeb trading platform is actually in talks with clients and industry groups about US default contingency plan. So nobody is really ignoring it, although most people believe that it will invariably be resolved even at the last minute. Now, look at inflation in US. We did have Michigan consumer sentiment data that saw a big drop from in the sentiment. But what the market looked at was the inflation expectations of 5 to 10 year, which rose from 2.9 to 3.2%, and this is the highest reading that we have seen since March 2011. And that actually supported the yields, supported the dollar, and even saw the stock market fall. Dow was flat, but we did see S&P 500 and Nasdaq lose out about 1%. Now, speaking of inflation, Fed is far from going with the market expectations, and in fact, we had Bowman, Goolsbee, Barkin, all of them Fed members saying that they would consider inflation should ease further. And while Fed rates were having desired effect, they were open actually for more rate hikes. Of course, the market is not giving up. Market is still discounting at least 2 rate cuts this year. And so that's actually a big divide between market expectation and the Fed's official outlook. Now, if you look at the stocks, they have been languishing, rather the VIX has been languishing at its multi-year low. But historical evidence shows that such a prolonged period of low VIX is followed by an intense volatile period for stocks. But perhaps we need to wait because there are too many factors at play. We do not know what will trigger, and in the meantime, we expect a volatile range for the stocks. Then on the dollar, we have seen a significant move in the recent session, and which is not really the one would expect if you look at softer series of data from the US, and that that's mainly put down to the oversold condition of the dollar, some sort of a risk aversion leading to safe haven buying, and particularly ahead of the debt ceiling talks that are not going anywhere. We have the market looking to the safety of the dollar for the time being. In fact, the single currency, the euro, has been helping dollar index move up as we have seen Eurozone economy weakening under the weight of sustained inflation and high borrowing costs. And in fact, euro has been heavily overbought on the perceptions of narrowing differentials, and that probably is slowly getting into some sort of a question because Eurozone's data have been weak. In fact, some of the EC members are now speaking about meeting by meeting approach in view of the various uncertainties. Now, UK pound obviously has been much better performer than the euro. That's also evidenced by not only the rate hike prospects, after the rate hike last week, when there are expectations of another 2 rate hikes, but it's also been followed by good number on the GDP. GDP came at 0.1%, which was better than what was expected to be a contraction a few months back. Although the month-on-month number came worse. But if you look at the industrial production data, once again, there was a rise, and also the trade balance has been improving. So overall, UK economy is giving a better picture. Mr. Pill, the economist from BOE, has been saying that inflation could fall drastically in the coming months. So that is something they would like to look forward to because if there is growth along with falling inflation, that would be the best case scenario for the pound. But all in all, dollar has made some good move up in the last few days. I would put it more to its oversold condition, particularly against the euro and the GBP. Commodity currency is obviously taking hit because there are more than one concern. One is the global recessionary fears, and then the debt ceiling fears, and of course the China slowdown, which is actually pulling down the demand for commodities. And China itself has been on the receiving end in the sense that the currency has been weakening steadily because we see deflationary trend in China, negative factory gate prices last week, and lower imports, which means that demand is substantially down. So Chinese yuan is steadily weakening, possibly heading towards a 7 mark. So we look forward to one more volatile week, although we have a lot of data that is coming up this week. We do have the Empire State Manufacturing Survey, which is now gained some importance because it's one of the forward-looking number, and we do have the Philly Fed survey, one more forward-looking data, and Friday we have all the important retail sales data, followed by Fed speak from Powell and Williams. So a lot to look forward to this week, apart from that debt ceiling talks, which are scheduled for tomorrow. Thank you.
Okay, that was quite good. And yes, folks, we have seen the core inflation for the Indian markets come down at 5.2%, which augurs well for the central bank, and it makes a good strong case for the RBI to keep the rate hikes at bay and continue with what's going on. Even though there is some more rate hikes expected from the European Central Bank and the Bank of England. Uh, Today we have the trade numbers coming in for the Indian markets, and it's another key data which is being observed quite closely for the kind of demand the overall dollar demand for the nation continues to hold. And if we have to talk about the international markets, volatility has been at multi-month lows, but yet it cannot be ruled out that we can observe some striking action coming in the recent days. Euro, which was heavily overbought, is now contributing towards the dollar index's rise, as we can see in the last week. Probably it is also, as JK mentioned, on the backdrop of a safe haven or a risk aversion observed in the markets. UK economy, though, is been posting good numbers, is also moving in sync with euro, though not exactly in the same intensity, but we have seen some correction coming in for the pound as well. So that's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.